It's 5 o'clock. Thank you all for being here. We'll go ahead and call the Human Resources and Insurance Committee meeting to order. Let me start by reading the emergency evacuation procedures. In the event of an emergency evacuation, an alarm may sound. Everyone should exit the building by way of the nearest stairwell in a safe and effective manner. If the nearest stairwell is blocked by smoke, use the other stairwell. Do not use the elevator. Once you have reached the main floor, follow the exit signs to exit the building and quickly proceed away from the building. Please be mindful of others evacuating and of emergency vehicles. Okay, again, thank you for being here. We'll go ahead and get started. Jody, if you'd call the roll, please.
Mayor Mitchell?
Here.
Phyllis Crisp? Here. Gary Farmer?
Here.
Mike Lewis?
Here.
James Barone?
Here.
David Merle?
Here.
Bill Dunlap?
Here.
Mike Kaler? Tom Stinnett? Grady Caskey?
Grady Caskey had called, and he will be here, but he's running a little late. Okay, at this time, I'd like to ask if there's any public input on items on the agenda. Nope, seeing none. Should have the next two items are the minutes from the February and the March meetings. Should be in your packet. We entertain a motion separately to approve those, or a motion to approve those together. Motion to approve. And a second by Ms. Crisp. Any other discussion? All those in favor say aye. Aye. Any opposed? Motion passes. Okay, item 5, discussion and possible action on handbook policy updates. Jenny?
Thank you, Mr. Chairman. We reviewed these items at the last meeting and determined at that point that we would have the attorney to review these policies. In your packet, there is a letter from the attorney, and he believes these changes are appropriate and can be implemented as recommended. So we'll just, I guess, need a motion to implement these as recommended and forward them on to commission, I believe, Chairman.
Make a motion that we forward these on to the commission.
They are on start on page 8? Oh, not that packet on your computer. Sorry.
You've lost him now.
In the packet, the electronic packet, the handout that's on your desk is something that we received today that we'll talk about in just a few minutes. It's page 8 of the electronic packet.
Jenny, if you would just quickly hit each one of those so all the members will know exactly what we're doing.
Sure. So the first policy update was on the pay periods. We need to update that to reflect the change from going semi-monthly to bi-weekly. So that is included in there. We have our sick leave accrual policy, which we are basically asking that the way it currently is structured is that an employee will earn 1 sick day per month of employment beginning on the 31st day of employment, and what we are recommending is that employees earn 1 sick day per month of employment beginning on the first of the month following the 31st day of employment, and then allocation of sick days will go on the first of every month thereafter. And that is just from an accounting perspective and accrual basis, it's cleaner to do it that way. It makes it easier for tracking. And Sheriff, we said last time that does not impact your accrual. It's done separately. So this is for general county. And then the last update on page 10 is our benefit effective effective dates and termination dates. Currently, our benefits begin on the 31st day of employment, and we're asking that they begin on the first of the month after the 31st day of employment, and then also that the benefits would terminate at midnight the last day of the pay period in which your employment ends.
Thank you, Jenny. Okay, would entertain a motion to either move all those together or separately as you wish.
The motion that I put on the floor, I'd like to move them all together.
Motion by Mayor Mitchell, second by Mr. Dunlap. Okay, any further discussion?
Mr. Chairman, I have one question, please.
Yes, sir.
In the pay periods, we were told that one of the reasons we changed on pay periods was everybody would be on the same pay schedule. Is that the case?
I can't speak to that. I'm not the payroll manager.
Don, you want to handle that?
No, I mean, yeah, I can't speak to that. Payroll's not under my purview, so I can't answer that question.
Doesn't look like we have an answer for that one.
Well, it says in here that they're not, so I just want to make that clear. We were told there was one reason we were doing that was to put everybody on the same payroll, and we're not on the same payroll, so.
Well, everybody will be bi-weekly, but the highway department and the library are already bi-weekly. So we're just getting general county on the
Yeah, but
same
they're paid
schedule.
they're paid on Thursday, everybody else will be paid on Monday.
That's correct, as I understand it.
Yes.
The same schedule, the pay date is different, the schedule is the same.
Any other discussion? Yeah, we need a roll call vote on that, Jody.
Okay.
Chairman,
Yes, sir.
on the benefits, does that include the retirement benefits, Jenny? Such as if someone comes to work for the sheriff's office and say I have an opportunity to recruit from another agency that's not the norm, and they're TCRS, does that have anything to do with that benefit starting? This does not address that. Okay.
No, this is health, medical, medical,
Okay,
dental.
that's just
Yep.
making sure.
Any further discussion? Okay, roll call vote, please.
Okay. Mayor Mitchell? Yes. Phyllis Crisp? Yes. Gary Farmer? Yes. Mike Lewis?
Yes.
James Barone? Yes. David Merle? Yes. Bill Dunlap? Yes. Mike Kaler? Tom Stinnett? Grady Caskey? Yes. All in favor?
Okay, motion passes. Item 6, discussion and action on Evergreen Solutions Resolution. Jenny?
Thank you. Yes, so the presentation that Evergreen presented at the last meeting is included in your packet again, along with the copy of the draft resolution. And just wanted to make sure nobody had any other questions before we proceed with a vote on the resolution. We said last meeting we would make the decision on that this month. And I'm asking, for this committee to adopt the resolution to provide the county with the necessary structure and foundation for the and to implement the recommendations from Evergreen. The Budget Committee will be determining if the financial impact from Evergreen, their recommendation will be sent to full commission. So what I'm asking for you are some of the non-financial pieces of the recommendation are the classification system that they are recommending, which ensures that we pay our employees correctly in regards to overtime. So we're gonna know for sure which positions are exempt, which positions are non-exempt, so that we make sure we pay our employees correctly. Job descriptions, we are gonna have the correct detail on exactly what our employees do. Performance reviews, we'll be able to evaluate, not everybody currently does performance reviews, so we'll be able to evaluate our employees' jobs performance and ensure that they're performing at the at a level that we expect. And if we do not have these pieces in place, then if the Budget Committee and Commission approves the funding for Evergreen's recommendation, I don't feel like I would be able to effectively administer or implement the plan. So I'm asking for your adoption on the resolution to put those structures in place. Thank you.
Okay, for the recommendation, is there a motion?
I'll make the motion that we adopt and approve the Evergreen. Second.
Motion by Sheriff Barong. Is there a second? Second by Mayor Mitchell. Any further discussion? Okay, Jody, roll call vote, please. Oh, I'm sorry. Yes, Bill.
Explain to this sentence in here under the job classification, pay grades and all this, whereas the Blount County Human Resource Director will administer the plan and make any and all adjustments to the plan with accordance to the plan philosophy and structure once approved and implemented. Is that taking anything away from the office holders?
No, sir, it is not. It just means that the office holder would need to, for those who participated in the plan, we would need to work together to make sure that we're not stepping outside of the plan, because all of the positions are going to be assigned a pay grade. So if if you have an opening and you fill a position, it's going to be mapped at a certain pay grade. So we want to make sure that we stay within those parameters. So it's just making sure that we're following the guidelines of the recommendation and the structure and the system that we're asking to be put in place.
Anything within the laws regarding that office holder, is this going to step on those toes?
It is not. Craig has reviewed the resolution and he is fine with that as well.
Okay.
Commissioner Farmer?
Well, it's sort of the same line with what Mr. Dunlap just asked, because if I'm reading that correctly, and then it goes on down to say that any prior resolution to the contrary is declared void, so that means anything they currently have set up is voided. That would, in essence, it was the same question Mr. Dunlap's asking.
I mean, the resolution was reviewed by the attorney, and he agreed with the wording. But what it's basically saying is the elected officials and department heads that have opted into Evergreen and chose to go through this study have all agreed that this recommendation and this structure is the way to go. And so someone has to help facilitate the process, and that's what the HR director position would do, whether it's me or whoever else is in this position. It's going to help facilitate that process. So Evergreen is going to come in and put these structures in place, and yes, it's probably going to, it may void something that's there to an extent from one of these things. Classifications may have changed. Evergreen made those recommendations. They are recommending that some of the classifications change based on what's already in existence. Am I answering your question?
No,
Okay.
Actually, you're fortifying my question. As it reads right now, if I'm understanding correctly, and same thing Mr. Dunlap asked, anything that is currently set up, it is voided. We're going 100% with the Evergreen resolution. That's it. And what they had set up previously is defunct and gone and now void, once this is accepted.
Those that have chose to participate in this, all the elected officials have agreed that this is what this does is give some validity and some structure to some departments that really did not have any
Right.
structure or any validity on what the personnel were being paid. We've all been involved in this, the elected officials, and the ones that have chose to participate in this, the schools and the highway department are not in this program right now. So this is but the ones, the elected officials that have chose to accept this, we feel like that this is the program and this is the system that we want in place.
Okay.
Commissioner Gasky?
Yes, Mr. Chairman, to follow up on that, I would question whether it follows the guidelines in Title V, Chapter 23 that deals with policies. In there's a process listed in Tennessee Code in changing policies, and I'm not sure, I'm uncomfortable giving the Human Resources Director that much authority to just change policies.
Can I
Yes, Jenny.
I don't believe that I can just, or this position can just change a policy without it coming to this body or to then on to full commission. You can correct me if I'm wrong, but that's the way I understand this position to work.
I think regardless, I think we may be reading this a little different, but the way I understand it is that once we make this recommendation, somebody has to implement it and put it in place and track it and make whatever changes we make as pay grades get changed and people change classifications. That's my understanding of what this says, that the HR director, HR area will take care of, which they should. I don't think it's talking about that if we decide 6 months down the road to make a major change to the evergreen system, that the HR area has the right to do that. They would certainly come back to this group or to commission for any structural changes within the evergreen plan. That's my understanding.
Basically, HR is simply the facilitator of this, correct?
That is my understanding as well. We have a motion and a second.
Yes, you do.
Do we have any other discussion? Okay. Jody, roll call vote, please.
Ed Mitchell.
Yes.
Phyllis Crisp. Yes. Gary Farmer. Yes. Mike Lewis.
Yes.
James Barone.
Yes.
David Merle.
Yes.
Bill Dunlap.
Abstain.
Mike Kaler. Tom Stinnett. Grady Caskey.
Yes.
7, yes.
Okay. Thank you. Motion passes. Item 7 is discussion and possible action on the current status of the health fund. Jenny?
Okay, you all have a copy of an actuarial report from CBIZ, which is the document I think some of you all were looking at earlier. They received that last night and provided that to us today, which is why I was unable to include it in your electronic packet prior to this meeting. Cole is here from CBIZ, and he's
Oops, my fault. Go ahead.
okay. He is going to discuss this report with us. However, I do want to go ahead and let you know we are not asking for you to vote on anything regarding the health fund or premiums today. However, we do have a financial issue that needs to be addressed. And before we hear from CBIZ, Mr. Chairman, I would like to recognize Don Stallions to provide this committee with some background and context on some information that leads to the report that you're going to hear about here in just a few minutes, if we can do that.
Certainly. Don?
Thank you, Mr. Chairman. I just want to give you all a little background on why we're here today and what Cole's about to talk about. If y'all remember late in 2012, early 2013, around there, we realized, many of y'all were on this committee at that time, we realized that we were having an issue with the fund, that we had revenue and expenditures. Expenditures was exceeding our revenue, and that there was a trouble in the fund. If you remember that time, we all came together and with our consultant at that time, we made major drastic changes in the plan. That was in April of 13 to go into effect into 14. That's where we did the 4-tier and the spousal carve out. Going into, after those were enacted into 14, through meetings with our consultant and from reports from them, it looked as though it had worked. What you all had done had worked, and that At the end of the year, into 14, we were going to probably break even. It didn't look like we were going to lose any money or run a surplus. It looked like the fund was going to break even. So we didn't come to you all at that time. We had no recommendations were to leave the funding alone, to leave the plan design alone. That looked like the changes made were working. Jenny came aboard about this time. We were meeting with Randy. This would have been in 14, probably late 13, early 14. Wanted to know why we didn't make any recommendations for plan design change or for funding increase to you all. We said, well, it looks like everything we've got, we're going to break even. And he said, well, we just got the audit back from the state, and there's a $1.4 million deficit that you're showing. You had your expenditures did not meet your revenues by $1.4 million. We were shocked to hear that. We immediately got with our consultant at that time to see what the discrepancy was. And apparently what had happened is on the reports that we were receiving that the formula to calculate revenue was flawed, so revenue was overestimated. Like I said, this time we were kind of in the handoff with Jenny in HR, so this is about the time Jenny took over. So once we realized that what had happened, that the report was flawed, that the formula was flawed, we proceeded. I'm going to let Jenny take over from there because that's about the time that she took the lead on this.
Thank you, Don. So what Don has said, and that background plus me being new to the position and wanting to put a fresh set of eyes on things is what led to the decision to ask this body to submit an RFP to market for a new broker. And CBiz was one of those finalists and was the one that I brought to the committee for approval. And you all approved them as our broker, and that went to the March commission meeting, and it was approved there. So they have been our broker essentially since the 1st of this month, so April 1st. They have hit the ground running. To my knowledge, this is the first time we've had an actuarial report done on the fund. Mr. Chairman, if we could at this time, I would like to recognize Cole from CBiz to review this report and provide us with some further information.
Thank you, Jenny. Cole?
Thank you, Mr. Chairman. Thank you, Jenny. As Jenny had mentioned, we began this journey with you all as of April 1st of this year. So for those of you that have had experience in the insurance world, we're looking at basically this is the beginning of our 3rd weekend, and you all are not really a small entity when it comes to insurance. You have right around 4,000 total members or 2,000 employees. With that being said, we were able to pull together an actuarial report. My actuary has made me promise that I'd let you know that this is an illustrative report so far. Just given the time and the reports it takes, generally this type of review does take at least 6 weeks to put together. So we're in the beginning of week 3. But this does give us enough data to show you that, as Don had just mentioned, we have an issue that needs to be addressed. My purpose today is to discuss the issue of where the numbers are coming from, but not necessarily to give you a recommendation on how we're going to fix it just yet. That is going to come from multiple different buckets, and this is not a one-size-fits-all, that we can just make one change and all of a sudden you're going to be okay. There are multiple different areas that we need to address, as well as different time periods that occurs. If you have the packet in front of you, the 2 pages that we're really going to focus on today, and especially with respect to time, is going to be pages 4 and 5, which I believe those may be the 2 pages that you have. Is that correct? The whole packet, okay. We're going to really focus on just pages 4 and 5 today. Again, these numbers might change slightly just as we are able to get more reports. As I've been in discussions earlier, some of the reports that we need to really put something like this together are reports that have never been created from Humana or from the stop-loss vendors in the past. So we're really having to start from scratch here. So that is why some of the things will be changing. There's different classification of employees that need to be broken out as it pertains to claims and funding mechanisms. So we'll get into that later at a later time as well. So to briefly go through this, number one on page 4 gets into the enrollment snapshot. You will see that the vast majority is going to be employee, but the main number to look at is your total. You have 1930. This means total number of employees on the plan, 1,930. This does not take into account the family of 5. So this is purely 1,930 employees, of which 515 are families, 214 are employee child or children, 223 are employee spouses, and 978 are employee onlys. The number 2 is going to be what your current structure is set up as. You'll see that the employee-only base rate, and this is what your whole funding mechanism is based on. So this isn't what the employee pays. This is a combination of the employee and the county to derive what your total revenues come in from the employee count above. So your employee-only base rate of $450, and then going on down all the way to your family rate of $1,150. You'll see that your employee-only share of $25, and this is on a monthly basis for employee-only, and then the family share up to $175. And then the ER, that stands for employer, or for your purposes, the county. That shows the county coming in at $425. So on a monthly basis, that gives you all of the totals based on the enrollment count above. One of the disclaimers is whenever we do a report like this, the only way that we can truly do this is assuming this enrollment count for the 12 months. So there's going to be some slight variation based on enrollment of people coming on or coming off. But for budgetary purposes, this is going to be a good number to go by. The next part, when we get into expected costs, this is a part that is what we're stating. When I say expected, this is what, as of July 1st, if you want to have it to where you have no longer the bleeding in your fund, you would need to increase that total base plan share from above by 16.84%. Okay, does that make sense? All right, so the way that would look is then if you go down below to Part A, the base plan would then go from the 450 to 525. I will say that I can go ahead and recommend that you do not change the employee contributions in July. So this is purely just stating that if you were to make an adjustment here that you'd want to recommend a change in the county side of it. The reason for that is with healthcare reform, if you make any changes to your plan design off of the renewal date, which your renewal is January 1st, you have to give the employees 60 days notice of that change, as well as open it up to new open enrollment, which would mean we'd have to do all of that by May 1st. So logistically, it'd be near impossible to do such a huge task. So that does probably need to come off the table as one of those options. But overall, if you want to stop the bleeding, that's what it would take so far based on our analysis to do so from a county perspective. When you get into number 5, this gets you into where the fixed cost is as of a percentage of expected funding rates. I don't want to get too much into that other than the PPACA is going to be your ACA fees. So that's going to be what we call the PCORI fees. Every self-funded plan has to account for, as well as your transitional reinsurance fees. Those fees are temporary for the next couple of years unless the government decides to extend that after that piece is up. And that will now be part of the administrative function since we're now into that fully. The main source of data that we want to get into though is on page 5. So let me explain the columns at the top. On number 6, the fund adequacy report. You have a total enrollment again of 1930, so you'll see that from March to December. The numbers at the bottom, when you see the total, please keep in mind, because this can be easy to miss, this is based on 10 months, not 12 months. So when you see numbers and you look at budgetary numbers, they may not match up, and the reason for that would be because this is on 10 months, the budget's going to be on a 12-month basis. We're going to base everything as of February 28th, 2015, and this is fairly close to where your overall balance is. The important column is going to be out all the way to the right where you see the monthly balance in the account as of the end of the month. So we're starting off at the end of February at $4.875 million. All right, do we all see that? The column directly to the left of that is the gains and losses versus current funding. So based on your current revenues pulling in from the county funding and the employee contributions combined, and then you compare that to the administrative fixed costs and the claims that are being paid out, which are going to be B, C, and D. Right now we're projecting that every month you're losing $255,000 into that fund. Okay. So that's where, again, on the previous page, we're talking about what the expected percentage would require. If you hit that expected percentage, that $255,000 would then be at $0. So if you were to make that change for July 1st, you'd see all the way to the right that your balance, let's see here, as of the end of June is $3.8 million. If you were to make that effective July 1st, and presumably that would mean your balance would remain at $3.8 million for the remainder of the year, which would keep you in a good place. Your paid claims are going to be in column D, which are going to be the important part, and you stratify that out and to the annual part. The next important section is going to be, you see the bolded part, it says estimated IBNR at 12/31/2015. So the IBNR, for those that may not know, that stands for incurred but not reported. That's going to be a very important figure given your status within the state. The incurred but not reported is stating that the total funds needed as of 12/31/2015 is going to be $2.1 million, right? Your fund balance, if you stay as is and continue the bleeding, will be at $2.3 million. So that doesn't mean that you have $2.3 million at the end of the year sitting there. That means that you essentially have $200,000 sitting there at the end of this year, because you have to account for the IBNR in your funds when you're doing your accounting, because the IBNR is effectively a liability that goes against your books. So if assuming that you were to not make any changes until January of 2016, that gets us to our anticipated rate action as of January 1st, 2016. Again, this is assuming that we don't make any benefit plan changes. Everything stays the same, minus a few. This does have a few trend factors included, like what normal medical trend is, which we have set at 7.8%, which is actually kind of low compared to the industry, but we want to have it at a fair number. So you're at 7.8% on medical trend, as well as a slight increase with some of your premiums that would go into effect. And again, this is keeping it directly as if you had no changes. If you wanted it to where you had no more bleeding, again, starting January 1st, you would have to increase the overall claims fund by 20.34%. And that number is located in that part where it says anticipated rate action, the midpoint. So at the midpoint, that will keep it to where you're at even. If you're at the high point, that would actually build up your fund balance to where it needs to be, or to get it to where instead of it going negative or neutral, it's going higher. And then the low part will continue to bleed out your fund. If you keep it, though, just at the midpoint and not increase your fund balance based on the prior year, and then you look at the claims exposure from the medical trend increase, and then also the premiums for admin going up just due to medical trend, you will notice that at the end of the year you'll be at $2.1 million in your fund balance, but the IBNR is requiring $2.2 million, so that would expose you in some form or fashion to be a negative on your fund balance. Long story short, what we're saying is that there are a lot of opportunities to fix this outside of just increasing the county funding from many different buckets, but this would be the year that we'd really want to look at doing that effective. For the majority of those changes would be January 1st. But that there definitely needs to be something done, otherwise you will be running out of money effectively on your fund balance. Do you have any questions?
Sure, there'll be a lot of questions as we go forward,
sure.
Cole, but basically the picture that you've painted here is our information, which has caused us to end up where we are, was based on a bad formula that caused us to get numbers that were not accurate as far as claims versus revenues.
Absolutely.
And so where we are today is basically a $2.1 million shortage that your recommendation is, or you think that not many of those changes can occur prior to January of 2016?
The only ones that could occur before January 2016 would be really the county itself putting in more into that fund. We do have one of your renewals is up July 1st, and that will be your stop loss renewal. And we're just now getting some information about that. I don't necessarily see that as an opportunity to reduce costs, though, given just your claims history over the past year has not been favorable. We can make some tweaks to some benefit designs, and we are aggressively shopping that market, but I don't necessarily see that as an opportunity to save.
But in your opinion, if we do any of those prior to, or if we do in those in July, it won't be enough to slow down what is already a deficit, a growing deficit in that fund?
The things that you could change logistically are the areas that we will be recommending will be areas that logistically I don't think the time available to make that change by July 1. But I do believe they will make a change in your trend and your overall costs. It's just the time constraints to be able to implement it. It essentially gives you a week to do so. And that's typically a process that takes almost 6 months to do. So.
Okay, thank you. Questions from the committee? Mr. Gasky?
Yes, you said there were 1,930 employees?
Correct.
The school system has almost that many.
The school system accounts for around 800 on the health plan.
It's more than that.
Jenny?
These numbers came directly from Humana. So as of February of 2015, we had 1,930 employees, and that does include the retirees that are on the plan. So that's the count of employees on the plan.
Mm-hmm. Yeah, it counts for around
Dependents.
250.
Dependents or more. Obviously, there's going to be more dependents.
Yeah, so, and that may be where you're considering. Overall, when you consider members, and this could be somewhat insurance jargon, but members-wise, you are around 4,000. So as far as covered lives, you're around 4,000. But typically when we do reviews, you look at overall employees, not dependents included.
That's part of the problem. We're the information that we've been getting, it's long on undocumented predictions and very short on details. If you look at the state audits, it tells a completely, totally different story.
Yeah.
Why don't we have the details and the difference in the health fund and the other funds that are mixed in there? I understand that the workers' comp and others mixed in it, but we went from a $2 million fund balance in 2010 to $8.5 million.
Mm-hmm. Yeah, and
why don't we have details on all of that?
Yeah, and that would be an area that you will be getting more details. It's just due to the time constraint. We had to keep a brief overview of where you would be at. The details are going to be in a lot of the reports that have to be generated, and in the past, they weren't specific reporting, and that's something that we have to create them basically from the ground up. But absolutely, there'll be more details, and this report will be, it is comprehensive in nature. The overall full report, I can tell you, can be upwards of 40 pages long, so you will have more details to it.
What are you basing your projections on?
Our actuary bases the projections on your existing data. You are of a size that you are credible whenever you consider from a claims perspective. Also, you've been with your vendor long enough to where the data that they have is also credible. So it's going to be based on that, as well as market trends within your industry. We have a vast amount of experience in the public sector from a funding perspective and actuarially speaking. So they base some of their trend numbers on actuarially approved methods from that piece of it. When you look at these numbers though here, like paid claims, stop loss premiums, admin, these are your numbers. Those aren't coming from anything but your actual given numbers. They're not projections. Except for going forward, those are projections, but those are based on your actual numbers.
Yeah, but it's saying, and this is the sheet that was in the packet, let's see, estimated expenses, $22.2 million.
Yeah, I can't
Now,
speak to that part.
I've looked at the past 5 years in the state audit, and our claims haven't come close to that. Not even close to that.
Yeah, what Cole is referencing is this packet. The sheet that you're referring to was in the packet that was there from the meeting that we had last month, just as a reminder of what we had talked about. We're not talking about that now. We're talking about the actuarial report that he's provided. So he can't answer any questions related to that. He can only answer the questions related to this, because he doesn't know about that.
Questions of this then, because those are legitimate questions.
Sure.
I thought.
I'm assuming, Randy, I don't know if you can answer that. He's referring to the page that was put together that was put in the packet last month. I'm not even sure if it applies anymore at this point. It's
It doesn't
it's this
apply
one.
anymore?
This one
Your,
here.
your claims have also have an upward trend over the last 2 years, but every year the trend is not going down. And some of that that's due to many different factors, but your average paid claims on a monthly basis is around $1.6 million. And that will, as of right now, probably continually go up. To give you an example, and we may have discussed this earlier, we looked at, and this is also in your packet, if you look at page 10, if you look at this, 2014, if you look at large claims above 125,000 for medical and RX, this is a typical report that you're going to get, because this is what we need to look at. Where are your high expenditures coming from? And for everyone on the committee tonight, just want to make sure you're aware this is absent of any PHI, is completely HIPAA compliant. There are no details about the claims here, so this is purely just a number. It cannot be identifiable to any one person. For 2014, the three that are shaded at the top, 888,327 and 295, those are from three separate claimants. The reason they're shaded is because your stop loss begins to pick up after $250,000. So that's in the previous category you showed a stop loss premium. That premium goes towards a separate insurance policy that picks up on any insurance claim that's incurred over $250,000, at which point the carrier will then rebate back any insurance costs above that amount, or any claims cost above that. So essentially for the first three to the county, your liability is $250,000 for each of those, so for a total of $750,000. The telling story, though, if you look at this, compared to 2013, you'll see just in that 1 year there is a significant increase just in the large claimants. But the more telling story is you have 11 claimants that account for over $1 million of claims. So when we factor that out over the course of the year, I mean, you're looking at close to $1.5 million of claims between 11 people, which account for basically, I believe I looked at it, around right around 1% of your entire population, since you have 4,000 members, accounting for 30 to 40% of your overall claims for this piece of it. So you have some high exposure with this area, and these are active claims that are not going away either. So there's different areas that we need to attack it, but really what the story is saying is that your claims aren't getting better. Your trend is an upward trend, and through benefit design and through other programs, we can help adjust that claim trend. And it can't just happen from the premium side. It has to come from many buckets, and that's where we'll attack it. But even though you may look at 2011 and 2012 and see that the claims were much lower, unfortunately, with the new drugs that are being released, there are drugs that were released last year that cost $30,000 per dosage. So for one complete treatment can be upwards of $90,000, and that's for one prescription drug. So there are some really high-cost drugs and high-cost treatments that are now around that weren't around even 2 or 3 years ago. Also, we were informed that a new cholesterol medicine will be coming out on the market. That's a specialty drug that will cost upwards of $600 per month. That may not seem high compared to the 30,000, but there's a lot more people with cholesterol issues than there are with the specialty condition that caused the 30,000. So, and unfortunately, the way the market is, it's not helping out the case from a claims side.
With all due respect, the state audits do not show the trend you're talking about. Actually, the claims were less in 2014 than they were in 2013, according to the state audit.
No, I've not seen the state audit, so I can't speak to that.
Mr. Vineyard?
One difference there may be on the accounting side. When we get the reimbursements from the reinsurance that Cole alluded to, for accounting purposes, those have to be deposited again, or have to go against the claims account because they're a reimbursement of claims. So you're seeing a net number. What Cole's talking about on the trends are gross numbers.
Yeah, and best I can understand, Randy, correct me if I'm wrong, there's no doubt that these numbers that we're looking at on the shortage is accurate. I mean,
We have a problem.
Yeah, I mean, it's not really arguable. The numbers from the state, I don't know if those are just for Blount County or for the state as a whole, but make no mistake, this is not an arguable deficit that we have to deal with here now, and that's I guess what I want to make clear is we're not guessing at any of these numbers. These are actual numbers that are here and already reported on the books and what's in front of us.
I would just question that because we don't even know how many employees, how many members are on their insurance.
We do, and this is correct. This is accurate.
1930.
1930.
You gonna
Yes, sir.
stand by that?
That
Yes, sir.
doesn't include everybody covered.
That's what I'm saying, members that are covered by insurance.
That is
That's
county
cost.
employees who are signed up for the insurance
Yeah,
program. It doesn't include dependents or...
The way that the revenues are driven are not by dependent. It's based on structure of the employee. So while there might be 4,000 total members, whenever you're looking at your gross revenues that you're bringing in on a monthly basis, those tend to be irrelevant as it pertains to your revenues. Because you have a family of 10, the overall revenue for that family of 10 is going to be the same as the family of 4.
I understand that, but employees are paying out of their pocket based on those members. We heard this song before, and then employees got hammered with premiums out of their pocket, and we said, well, we're going to fix that. And now all of a sudden, here we are, a year and a half, 2 years later, saying, we still got the same problem still exists.
I can't
and now
speak.
we're coming back and saying, well, we got to go back to employees now.
I can't speak to what occurred in the past, only to what I know as of April, but I can tell you that the structure for the family, a family of 4 pays the same as a family of 10, and the same as a family of 12 or 15. A family is construed of an employee, a spouse, and a child. An employee spouse is just a 2-member family, and then employee child can be anyone that is in the employee with the child or children, no matter how many child or children's there are, excluding a spouse. So the overall structure, they're not paying per dependent, and they never have been. It's just there are 4 tiers that they could be classified into that they pay by. And so that's where the employee count is, and this is the actual number based on who's enrolled in the health plan. There are 1,930.
Our premiums depend on who we have enrolled. If we have family members, we have to pay for that.
But it is capped, so it does not matter if there's 10 members or 4 members. It's the same.
We're woefully lack on information. I mean, we're just getting numbers thrown out here, and it doesn't match anything else that we've got. It doesn't even match the numbers the numbers that we get in our packet every month. I was looking at Fund 264, 263, and 266. None of the numbers match with what we're getting here.
One of the things to remember, Commissioner Caskey, is that they inherited this issue.
Mm-hmm.
CBS has been on the job for 3 weeks, and so we do appreciate the fact that you pulled what information that you've been able to to bring here and start the conversation. As we said earlier, there's no decision to be made today. This is information that this committee needs in order to move forward. So there'll be much more to come to talk about with this information, but make no mistake that we have an issue that has to be dealt with in whatever manner we choose to address it. And hopefully what we'll get here over the next 30 to 60 days are alternatives to look at in order to address the problem and correct it. Is that
Yes,
accurate?
that would be accurate. Thank you.
We need a lot more information.
Yes. Yeah, this is just the beginning. Yes, sir.
Other questions, comments from any member? Cole, thank you.
All right. Thank you.
Last item on the agenda, next to the last, is discussion and possible action on future meeting schedule changes with this committee. I think probably one of the things that we've discovered in the last couple months is that meeting on a quarterly basis may not quite be enough with the information and the issues that we need to deal with. So what I would like to do is ask this committee to consider meeting on a monthly basis. Probably easier to schedule meetings and cancel if we don't have enough, but it certainly seems like there'll be enough issues in the next 6 to 8 months to meet on a monthly basis. So would ask you to consider that, and if we could get a motion, would take a motion to move this. Got a motion by Mr. Dunlap and a second by Mr. Caskey. Okay, any other discussion?
The revenue and expenses in the health insurance fund, that would be very beneficial.
Don't see any reason why we couldn't do that. Okay.
I was going to say the same
Fine.
thing as Mr. Caskey, is we could have something every month that shows, revenues in, expenses out, kind of how that looks over time, because if we're going to make, as a group, make a decision, a good decision for our employees, not knowing what solutions are going to come back, and we need that every month, talk about that. And I think that's something our group hasn't always addressed, with what are these figures like on a monthly basis or every time we meet. So I would agree with that we need that every month. So.
That's a great idea. Mr. Vanya, can you make sure we get that information on a monthly basis, please? Yes. Okay, thank you. Okay, we have a motion and a second. Any further discussion? All those in favor say aye. Aye. Any opposed? Do we need a roll call on that? No, sir. No? Okay. Okay. Lastly, is there any public input on items not on the agenda? Seeing none, we'll take a motion to adjourn. We stand adjourned.